And as a beginner, I'm sure many of you have heard of your friends or family buying individual stocks. So maybe your dad or your friend might put $100 into Coca-Cola stock or Tesla stock or something sexy like that. The thing is though, is that investing in individual companies can take a lot of work. Oftentimes they are more volatile in their returns, and they're definitely like a more active style of investing. Think of like a day trader. A day trader is looking to maximize their returns on a daily basis. So they might be looking at a stock's performance by minute, by hour, and that's something that takes a lot of work, adds a lot of stress into your life, and it's not something that as beginners we want to do. A more passive style of investing will just involve buying all of the stocks in the stock market, kind of forgetting about our investment and just checking it once or twice a year and seeing our money grow over time. And the way that we're going to do that is to invest in what's called an index fund. So an index fund is something that a lot of financial advisors will put their clients into, and basically it's a fund that is well diversified, tracks the stock market, and as long as you invest in them over time consistently, the path to becoming a millionaire is almost guaranteed. So what is an index fund exactly though? So to understand what an index fund is, we actually need to talk about the fund that preceded it, and that's actually known as a mutual fund. A mutual fund is when many investors will pool their money together, they'll come together. So let's say you have $1 million and I have $1 million. We both give it to a mutual fund manager, and that fund manager's job is to try to give us the best possible return. They might raise more money from a bunch of different people, and by pooling that money together, they then pick a selection of stocks based on their expertise to try to get you the highest return. In exchange for this service, the money manager will charge a really high fee to its investors because the money manager is doing all the work, and also the money manager has kids to feed and a house to mortgage or a house mortgage to pay off as well. So they need to get paid a pretty high fee. So a mutual fund has a professional manager involved, but an index fund, on the other hand, is passively managed and it tracks an entire stock index. A stock index is something like the S&P 500, which tracks all of the 500 top companies in the United States. The NASDAQ is another example of an index, and in the UK, they have something called the FTSE. So they have the FTSE 100, which tracks the top 100 companies in the United Kingdom. So an index fund would automatically track and invest all those companies in that specific index. So all that we have to do as a beginner investor is buy that index fund. So on the screen right now, I have the S&P 500 companies by weight. Just to give you an example of what kind of companies are in the S&P 500, we can see that Apple right here is the world's largest valuable company. It has a weighting of 6.14% in the S&P 500. Microsoft is in here, Amazon, Alphabet, Exxon, Visa, Tesla, Home Depot. You get the idea. These are all larger, really, really large companies. As we scroll down the list, you can see that the companies will start to get a little bit more unfamiliar. For example, if we went all the way down to the 400s, I've never heard of Camden Property Trust. Never heard of it in my life. However, if you were to buy an index fund that tracks the S&P 500, your money would get split proportionally among all of the S&P 500 companies that we see here. So an example of an S&P 500 index fund would be like ticker symbol VFIAX. So a ticker symbol is like an airport code. So whenever you're landing at your airport, there's usually a 3-letter code, for example. So JFK would be John F. Kennedy Airport, or London Heathrow would be LHR. Stocks and investments also have their own ticker symbols. So if we scroll all the way to the top, we can see that ticker symbol for Apple is AAPL, Microsoft is MSFT, Amazon is AMZN, etc. So index funds are passively managed, which means that they don't have a professional money manager, which also means that there are not super high fees for owning an index fund. What the index fund does, it's just really a convenient way for you to invest your money and then get instant diversification among all of those holdings within the index fund. It's definitely a really great beginner strategy because it kind of takes the guesswork and the work out of investing. You just invest in everything. And so if you want some more further evidence as to why you shouldn't pick individual stocks, consider the tech company Intel. They were once a high-flying stock back in the 2000s during the dot-com bubble, but if you had chosen this individual stock back then, you can see by this chart that to this day, you would still not have broken through its all-time highs back in 2000. Now compare that performance to the overall stock market performance since 2000, which has 4 times since then. So this is the danger of picking individual stocks. While there is more reward sometimes, there is definitely more risk. And so what we're looking for is consistent gains over time because that's just really nice. Now, everyone's goals and time horizon are very different